Hello, everyone. So today's topic is the principles of insurance. So what exactly is insurance? Insurance is just kind of an agreement between and the insurance provider and the insured, wherein there is some kind of a guarantee or a protection that is monetary protection that is being given to the insured in case of any eventuality, that is some kind of an accident or some kind of mishap that could possibly happen within a stipulated time period and based on some terms that has been agreed. So what are the principles of so let's go through the slides of principles of uh, different principles of insurance. So we can see various types of insurance that are normally we can see in our day-to-day life, like health insurance, travel insurance. There is property insurance, insurance, or your car insurance, safety insurance, something like that. So let's go through the different principles that are there. So there is the first most is called the utmost good faith principle. There is the principle of insurable interest. There is the principle of indemnity, a principle of proximate cause, a principle of subrogation, and a principle of contribution, and principle of mitigation. So what exactly is if you have to take it a brief, the principle of utmost good faith is nothing but there should be trust between the two parties that carry out the contract of insurance. There should be trust or good faith between the two parties. And insurable interest means that insured must have an insurable interest in the matter of insurance, like there should be a reason for what has to be insured. Indemnity is in case of there is a loss of if there is if there is a death, or in case there is a loss of lives, the compensation can be given to some other party. For instance, in the case of a death, the inheritance can be claimed, and the people who are nominees, or the heir apparents of the uh, deceased can claim for the amount of insurance. Proximate clause refers to the nearest cause of that's leading to the loss. For instance, if you are into an health insurance, or if life insurance, for example. So if there is a death, so what is been governed by the what's governed in the clause, like in death due to accident, death due to fire hazard, death due to illness, which is the nearest cause of the leading to the loss. So subrogation is the right with the insurance company to sue a person or an entity responsible for any damage or disability suffered by the insured. So this can the insurance company can on be can go ahead and sue a person or an entity responsible for the damages, because the hefty amount has to be paid from the insurer. So they can also sue in to to ease or cushion some of the monetary damages caused due to this. Contribution is nothing but the principle where the insured cannot make a profit by claiming the loss of one subject matter from different policies or companies. You cannot claim the same thing. For instance, if there is a policy, there is a limited amount that can be covered. Multiple it cannot be covered for the same. If there is a death, that will be covered only by one. If there is 5 lakhs covered under one policy, further you cannot have multiple policies for the same. Mitigation is it's the duty of the insured to take responsible step to minimize the loss and damage to the insured property. So it's the duty of the insurer. For instance, we cannot just go and there cannot be any sabotage, like you yourself put your property into fire or any damages and then try to claim that should not be the case. So that that is also governed as a principle of insurance. And now let's go to simple chart that we can create for this one. As you can see, we can just put a chart wherein we can just have all the principles of insurance and also the 7 basic principles of insurance, that is utmost good faith, as discussed, insurable interest, the principle of indemnity, the principle of mitigation, the principle of contribution, the principle of subrogation, and the principle of proximate cause. That was the video, guys. Thank you very much.